This is the video demonstration on journal analysis, posting, and the trial balance. In this video, we're going to take a look at problem example number 1, and I'm actually going to work the solution to this problem. And this is probably one of the lengthiest and most complex problems that we will do in this particular course. And that's because initially there's a lot to learn in terms of debits and credits, journal entries, and how everything's going to work together to create the final trial balance. Now, the very first thing we have in this particular problem, it says that Adams Company has the following chart of accounts. So notice that they are providing us with a chart of accounts for that company. And we see all the account titles. We also see the account numbers. To be honest, the account numbers are not particularly important. It's just a number that is assigned to each account. But remember, we talked about this in the video lecture, and every company does have a chart of accounts. And this is the complete listing of all the accounts that that company maintains. So that means that if I'm going to have to do journal entries, I'm going to be using these actual accounts. And before we even take a look at the problem, it's actually helpful to look at the chart of accounts and familiarize ourselves with this particular company, because the chart of accounts does actually tell us a lot about a company. Now remember, no two companies are alike, and no two companies' chart of accounts are going to be alike. You're only going to see accounts on here for items that they actually use. So first of all, I see several assets. I see cash, accounts receivable, office supplies, prepaid insurance, prepaid rent, and office equipment. All of those are assets. Then I see one liability, which is accounts payable. Then I see the capital. In this case, it's the proprietor, G. Adams Capital, G. Adams Withdrawals. I see one revenue account called Services Revenue, and only one expense called Utilities Expense. So it just helps to familiarize myself with that chart of accounts, and in advance think about the types of accounts that we have on this list. Now it says the following transactions occurred in the month of January. And if I scroll through here, I see a whole series of different transactions that occurred throughout that month. And on the requirements, there are 3 things that are required. I have to prepare the necessary journal entries for all of those transactions. Then I'm going to have to post those journal entries to the T accounts, and we talked briefly about T accounts in the last video lecture. And then I am to prepare a trial balance for January. So I'm going to use all this information provided me on example 1 to do this problem. Now, this information that I'm using on example 1 is available on the class website. You have the option of printing this out so that you can follow along with me as I work the problem. But I'm also going to be flipping back and forth and referring to this information throughout the problem. So if that's okay for you and you can follow it that way, that's fine. But if you feel the need, you could always print this out, and perhaps it would be a little easier to have this in front of you to look at as I solve the problem. Now, in order to do this, the first step would be the journal entries. Now, remember, we talked about journal entries in our video lecture, and journal entries have a certain format. Now, to do this, I'm going to use Excel. And I use Excel in all of our problem demonstrations because I think it's easier for you to see what I'm doing in Excel, because everything's going to be typed out nice and neat and organized. And if you want to use Excel to solve your homework problems, you can do that, or you could just do this on paper. So I'm just using this, as a means to show you the solution, show you the example. But anyway, I've already set this up in advance with columns for the date, the account title, and then I have a debit and a credit column. And I'm going to be using this area to do all my journal entries. And I'll have to do a journal entry for every transaction. So let's look at the very first transaction. It occurred on January the 1st, and it says that Adams invested $200,000 cash and $25,000 in office equipment in the company. So that's the initial investment made by the owner. Now, when you first start doing journal entries, it may be a little confusing, but remember, we talked about in our lecture the debits and credits and the account behavior. And the more practice you have with journal entries, the easier they are to do. Now, this particular transaction occurred on January 1st. So I'm going to use January 1st as my date. Then I have the account titles. Now, in this instance, the owner is investing two things: cash and office equipment. Well, what jumps out at me right away is that cash and office equipment are both assets. So I'm going to use cash and I'm going to use office equipment. So those two accounts are assets. Now, what do I want to do with those accounts? Those two accounts need to be debited. Why debited? Because remember, debiting an asset increases it. So it said that the owner invested $200,000 cash and $25,000 in office equipment. That's what they invested in the business. So I'm going to put both of these in the debit column. And something else I'm going to do is I'm going to move these over to the far left-hand side. And that just more clearly shows that these are debits. Now, I've got two debits. I don't have anything as a credit. Every journal entry has to balance. So I can't have more on the debit side than what I have on the credit side. So I have to have $225,000 as a credit. So the question is, what account title am I going to credit? If I could figure that out, I would have this transaction finished. Well, in this case, because this is an investment by the owner, all of the owner's investments, that goes to capital. And the capital account in this particular company was G. Adams Capital. And I'm going to move this over to the right and indent a little bit to sort of show that this is actually a credit. So that's the first journal entry: a debit to cash, $200,000, a debit to office equipment, $25,000, and a credit to capital, $225,000. That will show the assets and the investment that goes to capital. Now, the next transaction. This transaction occurs on January 2nd and says the company is going to prepay $5,600 cash for 12 months rent for an office. So this is occurring on the 2nd. That's the date. I've got to record this. Now notice in this transaction, they only quoted one amount, and that amount was $5,600. Well, the nice thing about that is when they only quote a single amount in a transaction, then you automatically know there's going to be one debit and one credit for that amount, because you know the entry has to balance, and you know that we practice double entry accounting. So in this case, we just have to figure out the two titles. Now, what they did in this instance was they paid cash for rent, but they went ahead and paid for 12 months ahead of time. Well, anytime we pay for something ahead of time, that is a prepaid expense. And in this case, we're paying for the rent ahead of time. So what I want to do is debit prepaid rent, and I want to credit cash. Now, why do I do it in that manner? Think about it like this. Debiting an asset increases it. Crediting an asset decreases. So I want to increase my prepaid rent, $5,600, but I want to decrease my cash because I have less money now. I spent that money. So that's how I want to do that. That's the proper way to record that transaction. The next transaction is on January the 3rd. It says the company purchased on credit $15,000 in office equipment and $2,000 in office supplies, and it says payment is due in 10 days. Now, when I see a transaction like that, there's a couple things that jump out right off the bat. It says purchased on credit, and it says payment is due in 10 days. So what that tells me is we have not paid for this. So I know this is going to have to involve some kind of a liability. And I also know, because there are two different amounts, this is going to be a compound journal entry with more than 2 lines. Now in this case, what am I purchasing? I'm purchasing office equipment and office supplies, and this is occurring on the 3rd of January. Well, office equipment and office supplies, they both happen to be assets. So I want those 2 assets. And in fact, I want those 2 assets to be debits. So I purchased $15,000 in office equipment, $2,000 in office supplies. So by debiting, that will raise the value of both of those assets. Now again, I cannot have a journal entry that doesn't balance. I have to have $17,000 over here as a credit. Well, remember, we said this was a liability. We have not paid for this. So what kind of liability? Well, we only have one liability on our chart of accounts, and it happens to be accounts payable. So accounts payable is going to be the credit for $17,000. And that's just going to establish that we owe $17,000. We haven't paid it yet. The next transaction is occurring on January the 6th. It says that we completed services for a client and collected $10,000 cash. So it's occurring on the 6th. I only see a single amount, $10,000. So it's going to be a 2-line journal entry for $10,000. Now it says that I collected cash. Well, this is the first time we've seen that. We're collecting cash from someone. Well, that means the value of my cash is going to go up. So I want to debit cash, the asset, to show that I now have an additional $10,000 in cash. Why do I have that money? Because we provided work for a client. Well, that's revenue. We only have one revenue on our chart of accounts, and it happens to be service revenue. So that's going to be the credit. So that would be the proper way to record that particular transaction. Then on January the 9th, completed services for a client worth $5,000. The client is required to pay within 30 days. So it occurred on the 9th. The amount involved is $5,000. So I know it's going to be a 2-line journal entry for $5,000. And it says I completed work for a client. But in a situation like this, there would be a temptation to possibly make a mistake. This transaction is very, very similar to the previous transaction that occurred on the 6th, but it's actually a different situation. The difference here is, yes, I did the work, I provided the services, but what did it say on the 9th? It says completed services and the client is required to pay within 30 days. That signals to me they have not paid us yet. So that's a little different. So I'm not going to do this one exactly like I did the last one. It's going to be a little bit different. Now I am going to credit service revenue once again, but on the debit side it's not going to be cash. They have not paid us. So whenever someone owes us money, that is accounts receivable. So I want to debit accounts receivable rather than cash. So you see how it was a very similar transaction, but just slightly different. So you always have to watch out for that whenever you're dealing with those types of transactions.